Hello everyone, welcome to Hash Commerce and Dollar Accounting. In today's session, we will dive deep into an essential accounting concept, trial balance. This is a crucial step in accounting that ensures accuracy before moving forward to financial statements. By the end of this session, you'll have a clear understanding of what a trial balance is, why it is important, and how to prepare it with practical examples. A trial balance is a statement that lists all ledger balances at a particular date to check the mathematical accuracy of the accounting records. It helps to ensure that total debits equal total credits. This is crucial because in the double entry system, every transaction has equal debit and credit effects. 1. Error detection. It helps identify arithmetic mistakes in ledger postings. 2. Financial statement preparation. It is the base for preparing the profit and loss account and balance sheet. 3. Summarization. It summarizes all ledger balances in one place. 4. Verification of accuracy. If debits and credits do not match, there may be errors that need correction. A typical trial balance is prepared in a tabular format with 3 columns: particulars, debit, and credit. This format is essential for ensuring that all financial transactions are accurately recorded and balanced. The particulars column lists the names of the accounts, while the debit and credit columns show the respective amounts. This structure helps in identifying any discrepancies in the accounting records. For example, the cash account might show a debit of 50,000 rupees. This entry indicates that cash has been received or an asset has increased. The debit side of the trial balance reflects all the assets and expenses of the business, while the capital account shows a credit of 50,000 rupees. This credit entry signifies that the owner's equity or liabilities have increased. The credit side of the trial balance includes all liabilities, revenues, and equity accounts. Purchases could be listed as 30,000 rupees in the debit column. This entry represents the cost of goods bought by the business, which is an expense and thus recorded on the debit side, and sales as 40,000 rupees in the credit column. Sales are recorded on the credit side because they represent revenue earned by the business. Rent might be 5,000 rupees in the debit column. Rent is an expense for the business and, like other expenses, it is recorded on the debit side of the trial balance. And commission received 5,000 rupees in the credit column. Commission received is a form of income, and therefore it is recorded on the credit side of the trial balance. The total for both the debit and credit columns should be 85,000 rupees. This total is derived by summing up all the individual debit and credit entries listed in the trial balance. As seen, the total of the debit and credit columns must be equal for the records to be correct. This equality ensures that the accounting equation, assets equal sign liabilities plus equity, holds true. If the totals do not match, it indicates that there may be errors in the accounting entries, such as omissions, duplications, or incorrect amounts. Therefore, preparing a trial balance is a crucial step in the accounting process to verify the accuracy of the financial records before proceeding to the preparation of financial statements. To prepare a trial balance, follow these steps. First, list all ledger accounts and extract balances from the ledger accounts. Next, categorize these balances into debit and credit. Place debit balances in the debit column and credit balances in the credit column. After that, total both columns and ensure that both sides match. Finally, check for errors. If there is a mismatch, recheck ledger postings. Even if the trial balance is tallied, some errors may still exist. This is because the trial balance only checks the arithmetical accuracy of the ledger accounts. It does not verify the correctness of the transactions themselves. Therefore, understanding the different types of errors that can occur is crucial for accurate financial reporting. Errors of omission occur when a transaction is completely omitted from the books. This can happen if an invoice is misplaced or a transaction is simply forgotten. Such errors can lead to significant discrepancies in financial statements, as the transaction is never recorded and thus never reflected in the financial reports. Errors of commission happen when a transaction is recorded incorrectly. For example, 500 rupees entered as 50 rupees. These errors can occur due to simple human mistakes, such as typing errors or misreading figures. They can also result from misunderstandings of the transaction details. Such errors can distort the financial data, leading to incorrect financial analysis and decision-making. Errors of principle occur when an expense is recorded as an asset, or vice versa. This type of error arises from a lack of understanding of accounting principles. For instance, recording the purchase of office supplies as an asset instead of an expense. Such errors can misrepresent the financial position of the business, affecting the accuracy of financial statements. Compensating errors are when two or more mistakes cancel out each other. For example, an overstatement of income in one account might be offset by an understatement of income in another. While the net effect on the financial statements might be zero, these errors can still obscure the true financial performance and condition of the business. Identifying and correcting these errors is essential for maintaining accurate financial records. Let's assume a business has the following transactions. Purchased goods for 10,000 rupees, paid in cash. This transaction is straightforward and involves a simple exchange of cash for goods. The business now has inventory worth 10,000 rupees, and the cash balance is reduced by the same amount. Sold goods worth 15,000 rupees received in cash. This sale increases the cash balance by 15,000 rupees and reduces the inventory by the cost of the goods sold. The difference between the sale price and the cost of goods sold represents the profit earned from this transaction. Paid rent of 3,000 rupees. Rent is a regular expense for the business, and this payment reduces the cash balance by 3,000 rupees. It is important to keep track of such recurring expenses to manage the business's cash flow effectively, and the owner invested 20,000 rupees as capital. This investment increases the business's cash balance by 20,000 rupees and is recorded as an increase in the owner's equity. Such investments are crucial for the growth and expansion of the business. After posting these in the ledger, the trial balance will look like this. The trial balance is a summary of all the ledger accounts and their balances. It helps in ensuring that the total debits equal the total credits, which is a fundamental principle of double-entry bookkeeping. Cash account, debit 22,000 rupees. This includes the initial cash balance, the cash received from sales, and the owner's investment, minus the cash paid for purchases and rent. Capital account, credit 20,000 rupees. This represents the owner's investment in the business. It is recorded as a credit because it increases the owner's equity in the business. Sales, credit 15,000 rupees. This entry records the revenue earned from selling goods. It is credited because it increases the business's income. Purchases, debit 10,000 rupees. This entry records the cost of goods purchased. It is debited because it increases the business's expenses. Rent, debit 3,000 rupees. This entry records the rent expense. It is debited because it increases the business's expenses. The total for both debit and credit is 35,000 rupees. This ensures that the ledger is balanced and that all transactions have been recorded correctly. Since both sides match, the ledger balances are arithmetically correct. This is a crucial step in the accounting process as it verifies the accuracy of the financial records and ensures that the business's financial statements will be reliable. A trial balance is a fundamental tool in accounting that helps ensure accuracy before preparing financial statements. Understanding it conceptually will make the entire accounting process smoother for you. If you found this session useful, don't forget to like, share and subscribe to Hash Commerce and Dollar Accounting for more in-depth accounting lessons. Stay tuned for the next video where we will explore final accounts and their preparation. See you in the next class. Happy learning!